Hey guys, welcome to today's session. Right, today's session is a simple, live analysis session. Right, we'll be covering the key news breakouts. Right, the key news events, for the upcoming week. Right, along with how it can impact the markets. We have a very busy week. Right, you've got FOMC news announcement. We've got a couple of other big news events to watch out for, and of course, the overarching banking crisis that is overshadowing the whole market. All right. So in today's session, we're going to invite Ketan. Right. He'll be taking you through how he actually looks at the markets. Right. He'll be taking you through it from a fundamental and technical perspective. Right. And he'll show you that he'll be looking at a little bit more in-depth approach to fundamental analysis and blending it with technical analysis. All right. So if any questions, feel free to ask, whether you're on Zoom, whether you're on YouTube, right? Feel free to ask. We literally have another screen open here. I'm just monitoring it, right? Otherwise, just sit back, relax, and enjoy today's session. All right. But remember, guys, everything in this webinar is educational in nature, so nothing should be construed as investment or trading advice. Do your own due diligence before you guys trade. All right. So without further ado, all right, Miss, can I take over? This one might go in. Once it's done, you can click. You hover over this one. Hover over the green thing. You up and down. Yeah, and then you can click more. And more. And once you then click end. Okay. Yeah. All right. Have fun.
All right. Hi everyone. So it's been a very exciting week. So we've had the regional banking crisis in the US, and then over the weekend we've had going into the weekend, we've had the crisis in Switzerland with Credit Suisse needing a bailout from the Swiss Central Bank, as well as a potential takeover by UBS, which was finally confirmed by regulators early this morning, local time. So we've had a lot going on in the markets this past 2 weeks, and some of the key economic indicators coming up this week would be the FOMC, which will be on Thursday morning Singapore time, where the Fed will update their interest rate projections. And also we will have the Fed Chairman Jerome Powell making his press conference as well. Okay, so let's start off with that. So we will look at starting with the DXY here. So we have the dollar index. So we've had a very hawkish Fed starting in around February. That was when the first FOMC meeting took place, where the Fed raised interest rates by 25 basis points, and they also were very hawkish in their press statement and their press conference. So this has led to the jump in the dollar index and bond yields around this period, Feb all the way to where it peaked in the first week of March, or the start of the second week of March. So as we know, inflation is still pretty elevated, although it has been trending down over the last few weeks on a annual basis, but it is still historically pretty high. So hence the Fed was hawkish going into the first FOMC meeting of 2023. So we've seen this move in the dollar index from about 101 all the way peaking to about 105. So now with all the ongoing banking crisis, the Fed may be hesitant to raise interest rates very sharply. So looking at it, we have this site called, which is the CME Fed Watch tool. This is a useful site that updates the target probabilities of what the Fed is likely to do. So here, this is updated pretty often. And as of today, the page is now showing us the target probabilities of what to expect at this upcoming meeting. So the current target rate is 450 to 475 basis point is where the interest rates is. So over here in this first column, first column is showing the probabilities for a pause. So there is no rate hike. So the Fed will not hike. And the second column here, you'll see the probability for increase of 25 basis points. So you can see they're fairly even. So it literally is a binary chance of whether the Fed pauses or they raise 25 basis points. So looking at that, we can, although inflation is elevated, I think the Fed might be reluctant to raise rates beyond 25 basis points because as you can see, as we've seen, the markets are pretty fragile. So any further sharp increases in interest rates could really negatively impact the financial markets and credit markets. So it is very likely that the Fed will either choose to stay put or increase 25 basis points. So this meeting, this project, target probabilities will be updated as we get closer to the date. So just before the FOMC meeting, we may get a better idea of what the Fed is very likely to do. So when looking at the dollar chart, we're on the D1 chart. Okay, so if you look, we have resistance over here. Okay. We have a first resistance over here, and also we have we have a first support level over here. As we can see, the DXY has made a move from 192 all the way to about 105.55, where it ran into this overlapping resistance, and it has been pulling back pretty sharply since. And during the banking crisis last week, there was a strong bid in the dollar again, which has now started to sell off. Okay, so because although inflation is still relatively high, but because of what is going on in the markets, the Fed is probably not going to be sounding very hawkish during this upcoming FOMC meeting. So due to that, we can expect to see dollar bearishness in this security. Dollar bearishness overall, which would mean that we should see the dollar index moving lower from here. So this is something to take note of as we move into this week. So there's a lot of things going on, as especially with the news catalysts from the banking sector particularly seem to be overshadowing any other potential economic indicators coming up. So I think that's something that we should probably keep an eye out for. And we could see the dollar index move and break below the recent lows of 103.44, and it could even move all the way down to the first support, depending on how dovish they sound during the meeting. Especially Fed Chairman Jerome Powell's words during his press conference will be very important to see whether he continues to maintain his hawkish stance or not. But based on the target probabilities that we've seen here, the Fed is not going to be overly aggressive, and a no hike decision is very possible. And this would certainly lead to the dollar being bearish overall. Okay, so this is the dollar index here. And just looking at the markets overall, so if you look at, now we'll just switch over to the daily chart on the S&P 500 here. So if you look at it, okay, we can see we've identified certain yes. Okay. So we identified certain areas of resistance and support. So we have a overlapping resistance here. We've also have overlapping support seen over here at various points, and then we also have a potential buy entry and a take profit level, which is also around here, which is sort of an overlapping support level at around 3757. Okay, as we've seen, the futures have opened up. They opened up in the green during Asian hours, but now just prior to the European markets have begun, equity futures have begun to tumble based on the fear that is currently in the markets due to the ongoing banking crisis. So we can see that the markets, the S&P 500 closed at 3908 on Friday, and today it gapped up slightly. Today, yes, it did gap up a little bit, opening at 3931, hitting a high of 3939.70 before breaking through that first overlapping support. So if based on the news, we could have entered this trade earlier based on the fact that we have overall bad news, bad sentiment, and a banking crisis going on, and the price action broke through the first support level as seen here. This would have been the ideal entry point, and then it has gone down as low as 3908, and the price has retraced slightly. So in view of this, probably it would be a good a good level to probably short the market at the lows here, and then we can put a general a stop loss level at this overlapping resistance. So this is probably one of the trade ideas that we could probably be exploring this week based on what is currently going on in the markets. Similarly, if you will look at the dollar yen being an asset, a safe haven asset in general. So during times of crisis, we will see traders and investors buying up the yen, right? So we will see this across most of the yen currency pairs. So similarly to this, there's various support levels here. This is about 131.25, and we have a second support level at about 127.18. So as similarly to how the equity futures have moved, the dollar yen did gap up today, this morning. Yep, it did gap up a little bit, and it hit a high of 132.65 before reversing and dropping as low as, let's see, how low did it go, as 130.53. So there's a lot of bearish sentiment in the market, and as such, we should see the yen gaining strength over the next couple of days, or at least during this week at least. So one thing to also take note of is it has broken through this first support level over here. So this would have probably been a good entry point to take a position here, and potentially with a take profit target at around 127.18. Okay, so this is just to have a quick overview of how the markets have opened up this week, and also what we can expect with the FOMC meeting coming up in the middle of this week. Next, something that I would like to also talk about would be oil. So oil also has been a very interesting Okay. So it's also been a very interesting story with oil, especially since the start of 2022, when we had the Russia invading Ukraine, which spiked the prices of many commodities, including oil, wheat, agricultural commodities, energy commodities. So we've seen a big rise in oil from early 20, in January, in January 2022, going as high going as high as was it 125, almost $126 per barrel. Okay, so there's a lot of things we've seen, the big sharp rise in oil, and then it sort of went sideways. It consolidated, went sideways before it peaked again at about $121 in the middle of June, and it's been in a downtrend all the way before it started consolidating around here, fluctuating between $70 and $82 before finally breaking this level. So, but before we come to what is happening now, maybe we would like to take a look at first what is happening in oil as well. There's many factors that affect the price of oil: economic activity, production and supply levels, and also inventory levels. So speaking of inventory levels, we will look at the EIA crude stock oil. So this is the page where we can go to. If you just type in EIA in Google, it'll take you to the Energy Information Administration homepage for the US. We'll click on this. Okay, so we will go to This Week in Petroleum. Okay, so here you get a good summary of all the various aspects of the crude oil market. We talk about exports, talk about the export destinations, production, withdrawal. Okay, the Strategic Petroleum Reserve is something that's of quite of importance, and we'll talk about this a little bit later. So this is the inventory stockhold that the US uses for emergencies. So normally they don't release oil from this stockpile unless it is approved by the administration, and also in special use cases as well. So before we touch on this, we'll go look at the crude oil stocks here. As you can see, the blue line is the weekly line for crude oil stocks. So this is in terms of million of barrels. So we're about, okay, I'll pull up a better chart again. Yeah, let me pull up a bigger chart so we can see that more clearly. So, okay, if you go to stocks, okay, data, we look at stocks. Then we'll go to total stocks, weekly and monthly. Okay, so what we're going to look at is the commercial crude oil stock. Okay. So essentially, crude oil is all about supply and demand, and also in terms of OPEC oil production levels and also inventory levels. So we will just look at the US inventory levels in this session. So as we can see, after COVID hit, which was, so COVID hit around here. Yes, that's right, in March, April, and we've had a big build in crude oil stocks. So crude oil stocks, at least in the US, peaked in the middle of 2022 and have been steadily falling till, I would say, probably till about the lowest point was middle of last year. So in this period where we can see from June, July of 2020 all the way to middle of last year, we've seen the inventory stockpile actually reduce. So when we see a big reduction or continuous reduction in the stockpile, we can say that the demand for oil is strong. So the demand for oil is strong. Naturally, we would expect the crude oil prices to be bid. So when we look around here. So 2020. So if I, sorry, yes. So we have this big, sorry. Yeah, so during the pandemic lows, crude went as low as, actually went negative. Some of the future contracts actually went negative, but this is looking at the CFD, we can see it hit as well as low as $12 per barrel. And then after that, once once demand slowly started to pick up, it basically tripled in price from 12 to $40. So basically the price tripled in a relatively short period of time. And then, so okay. Sorry, okay, now we are back here. Yeah. So with crude oil inventory being relatively low from in 2021 to 2022, you could see crude oil was bid up relatively well. So we also look at moving averages. So I'm going to pull up the 10-day moving average. Together with the 20-day moving average on the daily chart. So we can see that yes, from all the way from the pandemic low, we are seeing rising 10 and 20-day moving averages, and the price has been riding along quite has been surfing the lines and has been we've seen it rise, like we said, 3 times. The price went up 3 times, and also there was a bit of consolidation and pullback here. But with inventory levels being relatively low, and also looking at what OPEC has been doing over the years with any product over the past couple of years, production cuts usually lead to a spike in prices as well. So over the past 2 years, even paying attention to what OPEC does is pretty important. So again, you can see together with the low inventory bill plus the production supply levels by OPEC, you can see that oil has also moved up from November from about $40 a barrel to as high as 67. So more than a 50% increase in price. And together with the moving averages, you can see that it's been rising pretty steadily, surfing the 10 and 20-day moving averages quite nicely. Okay, so this is just the general story with oil, or some macro fundamentals of oil, and pairing it with some simple moving averages. Okay, so at the end, so when we come here, okay, so coming into 2022, oil had sold off quite a bit, and looking at the moving averages, it actually bottomed around the $70 level, and then it made a nice move up. And then we had the Russian invasion, which took, okay, when did the Russian invasion exactly took place? Sometime in March, right? So let's see. Let's look at it. So oil had already bottomed prior to the invasion, and it had actually made a nice move up till the 24th. Yes. So here. So once, yeah, here we go, 24. So you can see this big wick in the candle on the daily chart. So from here, the price of energy commodities and agricultural commodities was spiked. It had a big spike, and oil went as high as 123. Oh, no, sorry, $126 per barrel. So initially, with any risk geopolitical news, you can expect energy commodities to have a big spike, as everyone was concerned that the the supply of Russian oil into the market would be cut short and there would be a scramble for oil from other markets. So after that, the oil went through a pretty volatile period, and it came down to as low as about, let's see, $93 per barrel. It ranged between 93 and about 115 before it broke out of this range. There's a very volatile period here before peaking at about $120 per barrel. So why did the oil price start to fall quite significantly in the second half of 2022? Well, part of the reason was because, as I mentioned, the SPR, which is the Strategic Petroleum Reserve of the US. So the Biden administration had gotten approval to release the barrels from this stockpile into the US market in an effort to keep the energy prices low. As we all knew, inflation was already embedded into the market, and they couldn't afford to have energy prices continue to stay high. So this is detrimental to both businesses and households. So business operations become elevated, household expenditure goes up, people have less money to spend on other necessities like groceries and other discretionary or non-discretionary products, discretionary products, sorry. Okay, so what has happened? Okay, so we'll just look at this case. So if I remember correctly, the US Department of Energy. Okay, this is, yes, here we go. Okay, so as you can see here, from about April or May onwards to October, the DOE had released about 100, or had planned to release about 180 million barrels over this period. So when we look at the chart, April is around here, right? No, sorry, April is, yep. So April is here. So this is the, sorry. Okay. So roughly here. So this is the period where the US had announced the SPR release, and it was the effective, the effective start date of the release would be around April. So hence, there was a pullback in oil prices before it peaked again. So eventually, it takes time for this new additional barrels to hit the markets. So once the barrels really started to come into the market, you could see the price of oil pulling back pretty significantly. So the program ended in October, which is over here. So you can see it probably in the price of oil and bottom just as the program ended as well. So with 180 million barrels of oil being released into the market, so it has helped to push down the price of oil, which naturally leads to other cheaper petroleum products. So retail gasoline prices in US naturally came down as well. They fell down as well. And this has helped to alleviate many of the costs borne by households, so lower energy costs, whether being in terms of natural gas or gasoline prices, provides additional spending power to the consumer. And also it helps business, and it also has alleviated business costs as well. So if you're running big industries or any other retail operations, restaurants and shopping centers, you have utility costs, energy costs. So the fall in crude oil has been pretty crucial to borne by businesses and households, and it has also in fact helped to push down inflation as well. So if you look at the annual growth rate of inflation, it has actually come down pretty steadily. Although it's still relatively high, it's come down pretty steadily. So now we've talked about SPR, we've talked about crude bill. So what is now, yes, so we go back to the inventory levels. So as you can see, inventory levels, let's see if I can zoom in on this chart a little bit. Okay, I shall try not to zoom in. So, okay, crude oil inventories pretty much bottom in December 2022. And after that, it's been building pretty steadily. So from as low as about 420 million barrels, it's gone up to size about 480 million barrels. So with this rise in crude oil inventory, it naturally translates to the fact that the oil demand is slowly pulling back as well. And that is why we have seen the price in oil come back. And once the SPR had concluded, the price of oil was has been consolidating between these levels, as there was no real catalyst for a break to the upside or to the downside. Okay, so now if you look at some overlapping resistance, okay, we can take. Okay, so here this is about 83. Yes, this is about 83.266. Okay, so we have a overlapping resistance level here at $83, and we have a support level at $70.35, and we also have another intermediate support level around here, which is about $72.60. Yes, it's about here. Oh. So oil has been ranging, yes, between 72 and $83 since the start, roughly since the start of the year, and there was no real catalyst for it to break out. But there were also opportunities to trade within this, because you would have been able to recognize the, I guess, a range bound movement in price action on a daily chart. So you could have probably bought oil at about 74, and with a target probability and a target take profit level at about $80. You don't want to take the full extension of the range. So probably between $72, $73 and $80 would have been right. It's a good level to look at, to either go long and short as well. Like you can use other various technicals to time your entry. So it's pretty good price action here in terms of range as well. So each trade up, each move up and down would have probably got you about 8 to 10% easily in profit in either direction. Or close at least at the highest point, and here probably a bit less. So now this ties in back together with what is currently occupying the minds of many people, which is the banking crisis. So why did oil break through this first support level of $73 last week? Right, this was on 13 March Monday. It touched it before retracing back quite strongly, but then the next day it finally broke through convincingly. Now why would this happen? So when there's a banking crisis or potential banking crisis, there is potential systemic risk to the financial markets. So what this happens is this could potentially lead to a recession where we have a global recession, right? If it's a systematic risk in financial markets, it would mean all geographies, all markets would be affected. So we could have a global recession, which could originating from the Europe or the US or anywhere, which would mean we would have high unemployment, lower economic growth, lower demand. So when that happens, naturally when people are unemployed, they'll spend less, they'll do less things, and businesses also cut back on their expenditures and their future purchases and whatnot. So because of that, this leads to a big slowdown in economic activity, which translates to a much lower demand for oil. That is why main catalyst that has driven oil to break through this first support of $72 pretty convincingly. And not only that, on 16 March last week, it has also broken through this December low at $70. So prior to this, if you're following oil pretty closely and you're looking at these range bound levels and following the news as well, you could have identified certain bearish breakout levels for crude oil. The first would have been at $72 and the second at about $70. Now it brings us closest to here as well. So although the markets have been, or the Swiss regulators have tried to calm the markets by negotiating a deal, or approving a deal that allows UBS to take over Credit Suisse. So despite the takeover being confirmed, there's still a lot of negative sentiment in the markets. So even with today, oil had actually gapped up at the start of the session, hitting a high of 67, 66. And if you look closely here, let me zoom in a bit. We'll go down to a slightly smaller time frame. Yeah. If we look at this now, we're on the 4-hour chart. So if you look at it, since last week, the low of 65.70 has been a relatively strong support for price for the level of for oil. And today, looking at the bearish news that has been going on, this support level was a good entry for bearish breakup. So you could have taken position today. Yes, today's market. Yeah, you could have taken a position, or probably highlighted this as a potential entry point at about $65.77, and with a potential take profit level at 62. Why 62? Because this goes to a very I guess a swing low that was formed back in December 2021. So it's a good level to probably take profit, maybe just above. You don't have to take it at about $62, probably a little bit higher, 64, about $63, probably just to be safe. I could progressively take out the position as you approach, or reduce your size as you approach this level. And the stop loss, you could probably set it as one level of stop loss would be the intermediate, the overlapping resistance here at $70.35, but also because it is quite a wide stop loss. Maybe if you would like to have a slightly narrow stop loss, taking the high of today as a potential stop loss level, which would be about 67, 66, would be a better level to set your stop loss. So if you were to set it around this level and you have a take profit at about 62, you're probably looking at close to a risk reward ratio of 2 to 1. So that's pretty decent to have. And this is something that is could likely to happen this week as markets kick off. Let's see what else can we look at. So look at gold. Okay, so this is now the daily chart on gold. So with gold is also another safe haven asset. So as I said, the overarching story over the last couple of weeks has been the banking crisis, and that has overshadowed many other probably data points and news catalysts as well. So looking at the moving averages and certain support lines. Okay, so we have overlapping support over here. So once we've seen the price action of gold move through the moving averages, so these are the 10 and 20-day moving averages. The purple line is 10 days, and the orange line is 20. So we can also see a nice crossover between the 10 and 20, which would potentially indicates a bullish move up. Similarly, like we saw in at the end of Jan, where we had oil top out at gold top out at about 1,940, and then it's move down through the moving averages and together with the 10 crossing the 2. So you can see the 10 and 20-day moving averages help to highlight the bearish move in gold as well. And similarly, conversely, we have seen it bottom around the 1800 level, and then it has moved through the moving averages, and at the same time we've seen the moving averages themselves rise up, crossover, 10 crossing over the 20, and are rising upwards. And because of the banking crisis, this has provided a catalyst for for gold to push through from about, let's say, 1,830 all the way to reaching $2,000. So this is quite a key level, and here probably maybe you could say this, since 2000 is a pretty important level, I guess that's maybe a psychological level. So it's potentially, you could see a lot of profit taking taking place around here. So this would be many traders would have probably identified the 2000 level in gold as a key level to start taking profit. Hence, we have seen oil having quite a wide range in move just today itself. So from here, potentially, we could see continued profit taking. Maybe we would see oil pull back more, or we could see it consolidate for a little bit. We're not too sure how this will lead on. So if the banking crisis does become worse despite the takeover of UBS, takeover of Credit Suisse by UBS, and with the regional banks in the US, if you have more regional banks in US joining the likes of Silicon Valley Bank and Signature, we could potentially see oil, maybe a gold break out of this 2000 level. Otherwise, if markets have been calm and think that the regulators have done enough to stem the damage in the financial system, maybe perhaps we would see gold consolidate, and perhaps and also once people start exiting their positions, naturally we can expect price to pull back. So there are many other economic data coming up. For example, we have the RBA minutes being released tomorrow morning, Singapore time. We also have a UK CPI coming up. So these are also other economic data that would be good to keep an eye on. But it does seem like the overarching story this week is the banking crisis and the FOMC meeting. So I hope this session has been informative to all viewers, and thank you for your time, and I'll see you at the next one. Right, take care, have a good day.